this one coming, Americans are missing car payments in record numbers now. 6.6% of all auto loans are 60-plus days late. Now, this is the highest level since the agency began collecting this data. The fall and winter of 2024 saw the next highest subprime delinquency rates and a clear sign that will seep over into the housing industry. Not the least of which is with your expectant mortgage borrowers who are now going to have a higher likelihood of having an insurmountable late on their credit report. Also worth pointing out, vehicle prices are higher, averaging just under $50,000. And higher loan rates? Yeah, over 9% for new cars and 14% on used cars. This is translating to steep monthly payments. Plus, car insurance rates are up 19% year over year, while repair and maintenance costs have risen an astounding 33% since 2020. Now, we just have to bring this up again, and I don't want to kick a dead horse. The problem is, it's simple. People are cash strapped. That's why we have to look for solutions in the mortgage space. Get a load of this. Did you know here's a solution? 62% of all non-QM loans are alternate documentation, meaning non-QM loans are finding a way to get people approved at these higher rates and higher prices. Only 26% of non-QM loans have a DTI over 43%, a massive healthier number than FHA loans and rivaling convention loans. Finally, only 17% of non-QM loans are interest only. With affordability still climbing off the charts, you can expect to see the number of interest-only loans increasing significantly for the second half of 2025. But here's the deal. The interest-only period is for a full 10 years. That's a decade. And after that, they just turn into a 30-year fixed-rate loan. Now, considering there's no prepayment penalty on primary residence, the borrower can pay down and or all off the loan if they choose to in the first 10-year period. The loan simply recasts, and the payment actually goes down whenever a payment is made on the principal. These loans are tailor-made for this market, and you would be astute to go out there and market these. You really can't beat them. Talk to my friends over at Oaktree, and they'll help you navigate all of your interest-only options. I mean, who knows? Maybe that interest-only loan is the difference between the house your borrowers really want and the ones that they have to settle for. Because here's a St. Louis Fed Reserve Board graph of home prices in the United States. They are higher now than they have ever been. Now, I don't know about you, but are you starting to get a bad feeling about some of these Canadian and Mexican tariffs? You know, where we get our supplies and our labor force for building homes? I'm starting to kind of think this administration needs to back off these tariffs a little bit and follow the lead of our trade associations and walk those woods, sheetrock, and shingle tariffs back. See, according to the Wall Street Journal, some materials such as lumber qualify for the 1-month delay announced last Thursday. Based on initial conversations with builders, the National Association of Home Builder chief economist Robert Diaz estimates that tariffs, once fully phased in, will add anywhere from $7,500 to $10,000 to the cost of building the average American family home. And finally, and possibly, how do you get the 10-year to come down? Markets need to show a weakness in growth. And here's the big one. Doge has to be perceived as actually working. Interest rates need to come down. The way to do this is to create massive uncertainties, aka tariffs, which can slow down growth in the short term, get the bond market to start buying bonds as soon as possible because of how scared investors are of touching stocks, causing yields to fall, which is what we need to do in order to refinance our debt. And then that gives the Fed the authority to lower rates, which continues to bring yields down. So although conventional wisdom says tariffs are inflationary and the 10-year should be spiking, or tariffs, well, it's actually going down because it's bringing so much uncertainty to equity markets, and people are selling stocks, and people, yeah, they're buying bonds again. I hope this helps.